Okay, thank you, and good evening, ladies and gentlemen. Thanks for coming tonight. I'm Phil Cleggett. I'm the Head of Corporate Development for Emmerson plc. Emmerson acquired the Moroccan Khemisset Potash Project in June last year and relisted on the LSE. So we've been trading on the LSE with this project for a little over 6 months now. Potash is a fertiliser, and it's really the reason we're really excited about this project. I'd like to start with a quote here from Bill Gates. 2 out of every 5 people on Earth today owe their lives to the higher crop outputs that fertiliser has made possible. Now, what Bill Gates is really saying here is that the reason that the Earth can support the population it's got today is because of fertiliser's ability to produce more food from the existing land. It's really relevant because not only has that happened over the last century or so with the population boom, but it's really forecast to be the reason why the Earth can continue to support the numbers of people that are widely forecast and accepted to be entering the Earth over the next 30 years. Most of the forecasts are very similar, and they predict that we'll be having about 2.2 billion extra people on Earth over the next 30 years. That's a city the size of London being added to the Earth 9 times a year for 30 years. Really what this means is that the food that we're going to require and the fact that it's going to have to come from decreasing amounts of arable land is only going to be possible with fertilisers. Now, fertilisers, there are a wide variety, but there's really 3 elements that go into the majority of fertilisers. These are nitrogen, phosphorus and potassium. The Khemisset project in Morocco is going to produce potassium in the form of potash, and this is widely forecast to be a hugely growing market over the long term. It's short term, it's going fantastically, but it's something that is, unlike a lot of commodities, predicted to be a consistent growing market for a long period of time. And down the bottom of this slide, you'll see that there's a little bit of focus on Africa. Now, there's going to be, over the next 30 years, approximately 200% growth in Africa's population, and that will account for 50% of the growing population in the whole world over the next 3 decades. Our project being in Africa is obviously great, but when you realise that there's currently 0 potash produced in Africa, you start to understand the opportunity here for a project like ours in Africa. This graph here, or chart, what it shows is the fertiliser application rates. If you looked at a world graph on the same scale, you'd see that Africa is red and the rest of the world is colours of green and so on. What the red represents is the lowest fertiliser application. So currently Africa is the least advanced part of the world in terms of applying fertilisers, and it has 60% of the world's uncultivated arable land. It is also widely projected, alongside their growing population, that Africa is going to be the source of the growth in fertilisers over the next 30 years. It's a place where all of the global fertiliser companies are really focusing their efforts because they see that it is the hotspot in the world's projected growing fertiliser consumption. And the companies that manage to corner that market will be huge beneficiaries of this undoubtable trend. Again, you can see here in the top left here, the little black dot is where our potash project is. It's in Morocco, and Morocco is one of the top 5 fastest growing import markets for potash in the world. Now, potash is a word that refers to any fertiliser that contains potassium. Now, it's a market of over 60 million tonnes per year, and of that 60 million tonnes, 60 million of muriate of potash, which is a generic product that we will be producing. So we're in a market that's 65 million tonnes approximately. Other potash products do exist, but they account for about 5 million tonnes. So there is one generic product, which is exactly what we're going to produce, that is the world's potash product. Morocco is one of the big consumers as it is, and it's continuing to grow. The reason for that is that there's a Moroccan company called OCP, which is a phosphate producer, which is a different fertiliser. They have huge amounts of phosphate, the world's biggest producer of phosphate. They are attempting to become the African fertiliser company that supplies all of Africa's fertiliser needs. To do that, they need nitrogen and potash. Now, they managed to secure nitrogen relatively simply. It's quite easy to produce from natural gas. What they don't have is any secure potash supply. they're currently importing it from all around the world and really struggling to fill their needs, and they're growing, as this graph demonstrates, rapidly in their consumption. They're really looking for somewhere to buy their potash from, and this is the case with a lot of fertiliser companies around the world. But OCP out of Morocco are really leading the race in Africa to supply this very valuable commodity. As you can see down the bottom here, the global potash demand growth is about 2 or 3% per year. That's been the case for a long time, and it's projected to stay that way while the Earth keeps adding population. 2 to 3% is a global number. The African number is more like 30% per annum. Like I said, we're talking about a 65 million tonne market. The product is worth about $300, $350 at the moment. So this is a $20 billion market. This is obviously a very big market that continues to grow and is forecast to grow for a long time. So the point of that is, how do you get exposure to this as an investor? Well, what we see in the potash market is that there's really two things that you need to focus on if you're trying to assess whether a potash mine can be built today. There has been one new mine built around the world in about 30 years. Potash is a commodity that has long been high barriers to entry and hard to enter for new participants. And why is that? Well, there's two things that are very important, and it's very rare that a potash deposit ticks both the boxes. The first is, what is your capital cost to production? It just so happens that the vast majority of undeveloped potash deposits around the world are incredibly expensive to build in the first place. Like anything, of course, keeping your costs down is important, but for a number of reasons, which I'll get into briefly, although we don't have a lot of time, potash is generally more expensive than most commodities. So they can be hugely expensive to build, and of course that means you can't get the finance to build these things. The economic returns, if you're spending billions and billions of dollars, are not reliable enough for banks to lend you the money or investors to invest the money. So you need to keep your capital cost of production down, or more importantly probably, be lucky enough to find a project where it's amenable to low cost capital. The second really important thing is your location relative to customers and high-priced markets. I'll explain what that means in a minute, but going back to the first point, here is a chart showing the capital intensity of undeveloped potash projects around the world. As you can see, the red line is the average for all global projects. So the average cost per tonne to build a potash project as it stands is over $1,000 a tonne, 1,142. The green line is Emmerson's project at $520 per tonne. So we're less than half the global average to get this mine into production. That means we have to borrow half the money per tonne of production, and it really ticks that first box that I talked about of getting a low capital cost project. Now the reasons for that, and you can see there is a large range left to right in terms of how expensive these projects are. There are a number of reasons, but I'll just get into one of them here just to give you an idea of how things can swing so greatly. Potash is almost always a deep underground commodity. You have to get down there if you want to mine it. Accessing the mineralisation can cost a huge amount of money. The vast majority of existing mines and undeveloped deposits are very deep underground, and almost always they have an aquifer above them, below the surface but above them. This is essentially a rock that's porous and has water in it. This causes all kinds of problems if you're trying to access it. Generally the way to access it through an aquifer is you build a very deep shaft. While you're building it, you have to freeze that entire aquifer around the area where you're digging through and keep it frozen for an extended period of time. Of course, this is hugely expensive. We in Northern Morocco are lucky. Nothing we did, but there is no aquifer, and therefore it's incredibly cheap comparably for us to access the mineralisation. The way that we intend to access it is via a decline. It's essentially a ramp, looks like a tunnel going through a mountain. You just dig it down there. It's a lot cheaper. You have to obviously structurally support and so on. But what that results in from a capital cost perspective is this chart on the bottom right. You can see us bottom second from left there. It's going to cost us $35 million to get down to the mineralisation. It's a lot of money, of course, but when you compare it to some of the other projects around the world, going up to BHP's project in Canada, it's going to cost them $2.6 billion, of which they've spent most of the money, just to get down to the mineralisation. we've done a scoping study. Our entire project is going to cost us about $400 million. That's far less than it's costing them simply to get down to their mineralisation. So this is just an example of why the capex costs in projects like this swing violently, and why we've been lucky enough to get one that's relatively incredibly cheap, and therefore it's realistically financeable. There are a number of other reasons, and we've been lucky in most of them, which has kept our costs down, as you saw in the previous slide, less than half the global average. So that's the first thing. The second thing that I mentioned was you need to be close to high price end markets. Now, of course, again, that's true of most commodities, but potash is a bulk commodity, so logistics are hugely important anyway, but also existing supply happens to be in very remote places around the world. 70% of potash today is produced either in Saskatchewan, in the middle of Canada, or in Russia and Belarus. The consumption is in agricultural countries. The US, Brazil is the biggest importer, China, Western Europe, and increasingly Africa. There is very little potash produced close to these places. So what does that mean? If you've got a project in Saskatchewan, forget what it costs you to produce the product. It is important, of course, but it's less important than freight and logistics. If you're in Canada, you go out your front door and you pay $20 or $30 a tonne royalties to the Canadian government. You've then got to go 1,700 kilometres by rail to get to the port of Vancouver. It's going to cost you $40 or $45 a tonne. From there, you've got to ship it all the way from Vancouver down to Brazil. And that's going to cost you another $30 to $35 a tonne. And you're going to go through the Panama Canal, $5 or $10 a tonne. So after you've paid to produce the product, just getting it to your market is going to cost you $95 to $130 a tonne. Now compare that to a theoretical project where we are in Morocco. There's nominal royalties, about 10 cents per tonne, so we've saved $20 or $30 a tonne already. We're 90 kilometres from the port. We'll put it on a truck, it'll cost us about $10 a tonne. Shipping to Brazil will cost us $12 or $18 a tonne. So once we're out the mine gate, it's going to cost us $22 or $28 a tonne. Compared to the 95 to 130, we're saving roughly $70 to $110 a tonne compared to these existing projects. Now for a commodity that's worth about $350 a tonne, that's a huge amount of saving you've got there. What this is demonstrating is that in any bulks, logistics is important, but in one where the existing supply is very remote, especially from the markets that we're targeting, we've got an enormous advantage. So how does that play out? Now this is a cost curve of all-in sustaining delivered costs to Brazil of all of the existing potash projects in the world, done independently by Argus, with us inserted. And what it's demonstrating, it might be a bit complicated, but there's 4 different colours for each project. Each one of those colours represents a different cost structure. The bottom 3 are really your costs involved in producing the product. And what you'll see there is that our cost is about here. So we're not pretending to be cheaper than existing mines. That would be ridiculous. What we've actually done, you see that we're actually quite expensive to get to mine gate to produce the product. But that's more than made up for with the logistics that we benefit from being close to our end markets. The top colour, the dark blue, really shows that if you're close to your customer, you can make far more money in production than just having one that's $5 or $10 cheaper to get to the mine gate. This is a demonstration of how we would benefit going to Brazil. Now if you took a market that was closer to us, such as Africa or Morocco, that advantage that we've got will be even greater, and you'll see us move further to the left of the cost curve. So it's just a demonstration of the second point that I said, the first one being low capital cost. The second point is how close are you to your markets. In a bulk, it makes all the difference in the world, and it's really going to benefit us. So that's the theory of how to get a potash project off the ground. Now we've done a scoping study. It's the initial technical and economical study. We released it to the market in November, and the results are really very strong. We're very happy with them. We've got an NPV of over $1 billion, 30% IRR, currently a 20-year mine life based on the resource that we've explored, EBITDA margins of 64%, post-tax cash flow of $184 million per year, paying back the capital invested in 3.25 years, and we're producing 800,000 tonnes a year into this huge and growing market. It's clearly a very attractive project as it stands, and we're looking to continue to work through it and improve it. At the moment we're drilling. This is a photo from our drill rig in Morocco. It's ongoing. We're drilling firstly to increase the confidence level in our existing resources, which underpin that report, but also to explore. We think there's significant potential to the northeast, and we can really add to the tonnes and hopefully find higher grade ore that will only improve our cost structure again. The exploration target is something that we're testing, and the results of that will be out later this year. And we're doing a relatively significant drill program. So what have we got? We've got a large-scale asset. This is producing, remember, cash flows of almost $200 million a year. This is a significant project. It's among the lowest capital cost projects globally, and as you saw from that chart, that's highly important and something that can really kill a project before it gets off the ground. EBITDA margins are estimated to be more than 60%. It's a very high number for any commodity project, and something that in a growing market is something that you'd hope with the growing market, potentially higher prices can only improve. Very strong. And maybe most importantly, this is in a market that's currently an oligopoly. It truly is. There are very few producers. It's very hard to get into the market because most of the projects around the world do not meet those two facts that I talked about. And therefore, in a growing potash market where there are a number of companies, and down the right you can see a number of giant global companies that are trying to enter or are already in the potash space and have trouble getting potassium, this is a strategically important asset that will have a lot of value to people who can't otherwise get control of potash. So we're very excited about the project on its own. We're also very excited about the market. It's just a slide about the team that we've got to execute this project. Our chairman, Mark Connolly, is an experienced mining industry guy. He's been responsible for a number of built mines in Africa and West Africa. He's the kind of guy that you want steering the ship when you're trying to build a mining project anywhere in the world, but especially in Africa. Hayden Locke's the CEO. He's got extensive experience in finance, but most importantly in mining companies. He worked on a company with Mark Connolly that got taken over for 650 million Australian dollars, a gold company in West Africa, which has subsequently been built. He's worked for a number of other companies, including potash companies. Rob Rickson has got extensive experience. He's a PhD in mineral economics. He's worked for Xstrata. He's also been the managing director of small resources companies. And Ed McDermott, last but not least. Ed is a stockbroker and company director. He understands the English market, he understands fundraising, and he really rounds out that experience. On the right-hand side is the management team. At the top's myself. I've got experience in financing mining projects around the world, including potash projects. We've got a number of in-country guys, including logistics experts, geologists, and general government relations advisors. We've also got Enrique Sands, who's our geologist. Enrique is maybe one of the best salt geologists around the world. Potash is a salt. Enrique ran Rio Tinto's global mineral industrials division while they were searching for potash projects. He knows every potash project around the world, and he wanted to come and work on this one. So we've got the team that can deliver from all facets. We've got geologists, we've got mine builders, and we've got finance professionals. So what are we doing at the moment? Like I said, we've done a scoping study. It was a very detailed scoping study that had fantastic results, but it is still a preliminary study. We're currently doing the drilling. We're going to be doing some metallurgical testing on the back of that drilling, and then we commence a full feasibility study. And this is really with the aim of fully de-risking the project, taking out any questions that can be asked of it, and also potentially optimising it and improving the economics, which are already great. So we've got a lot of work to do. This is all this year, and we're really looking forward to releasing the results to the market. So in summary, we've got this fantastic project. We've got over £3 million. That's enough to get us through that entire work project for this year. We hope to deliver the feasibility study, not this year, but we'll be well down the track, and we'll be slowly releasing the results of it as they become available. It's a potential for a low capital cost, high margin development, and this has already been confirmed by the scoping study and something we're looking to continue to show and potentially improve on. We've got the board and management to deliver. We're in Morocco now. I haven't talked about this. I've only got a short amount of time, but Morocco is a fantastic investment jurisdiction. It's been ranked as the #1 African investment jurisdiction for mining projects, and it's a place that we're very happy to be working. They're trying very hard to attract foreign investment, and they're doing a lot of things from fiscal regimes to permitting routes that really help us out. The potash market is fantastic. It's a commodity you really want to be in. It's growing strongly now. It's going to grow strongly for as long as the earth keeps adding mouths to feed. And I'm not sure why you'd want to be in any other commodity, to be honest. The exploration risk is mitigated with an existing large JORC resource. So we've got a huge amount of drilling, and we're looking to build on that. There's upside potential there as well. And we've got a defined development path which will take us right down the engineering pathway and hopefully into construction. So that's a summary of Emmerson. Look, I'm around later this evening if anyone wants to chat and take some questions now, of course. There's a bit of literature about the project up the back of the room if anyone's interested in that.